check and let me know if you can hear me audibly on the chat. If you can just pop in on the chat and tell me if you're hearing. Hey, there we go. Kevin, how are you? Okay, good. Got enough responses. We are rock and rolling here. Turn the camera on just for a moment so that we can say hi. I'm in kind of a, oh, wow, I guess I could turn a few more lights on, but that's all right. I'm not going to bother you with the camera. But I would encourage you to use the text chat this morning. And I guess it's noon on the East Coast, so whatever you want to call it. But Helen, how are you? Good morning to you as well. Afternoon for Brenda. All right. Well, I wish I could see all your smiling faces, but a lot of you I know, and I appreciate being able to visit with you about once a month, try to share some things with you that might be relevant to your trading, and also just understanding overall market involvement, because there's a lot of things that impact your trading that are ancillary, right? You should not be trading. Yeah, don't forget to share my screen. Yeah, I understand. Let's see. Let's go ahead and do that and just pull up the let's get a verification that you're seeing the Trading Coaches Playbook introductory slide. Yes. Very good. All right. For example, I would strongly suggest that one of the basic criteria for deciding if you're even going to trade on a particular day is how you're feeling. Jennifer, happy Friday to you too. It may seem like a silly thing, while I trade, and so I'm getting up and I'm going to trade. Well, it may not be a good idea to trade today. Quite frankly, guys, there are a number of criteria and things that should go into a trading plan. And some of the things that I've learned is that there are some, again, ancillary things that you need to pay attention to that you may on the surface not even feel like or seem like they relate directly to trading strategy, trading rules, etc. But they do. And we'll talk about that a little bit today. But let's go ahead and get started with the, excuse me, with the disclaimer that we always put up. That disclaimer is simply intended to make sure that you don't fall into any expectation that I'm going to give you, or any of the instructors are going to give you, any specific trading guidance on a particular trade, whether it's a commodity or a excuse me, pardon me while I clear my throat. You're the first people I've talked to today. So on any particular commodities or any individual stocks or entities that you may be trading. There's even some fun trading entities now that are available through, for example, Robinhood will let you trade your expectation of what happens next Tuesday for the presidential elections. So you can even trade those contracts. Those contracts trade out or pay off $1 per contract if you happen to trade the right contract and the party that you are trading for is able to gain office. There's trading contracts now for that, which is kind of interesting. But we're not going to be giving you anything other than what I consider good trading advice, good advice in general that applies to the market conditions around you, but not specific to any particular trade. Markets do have risk. You recognize that. Past performance does not equal future expectations, etc. Okay? So, once again, an amazing effort by Rob to continue to put good content in front of you on a regular basis, including Rob's new presentation coming up on November 4th. Next week, if you like it, put a fib on it. Interesting title. Again, I always give props to Rob because I know how challenging and how much effort it takes to put content in front of you, valuable content, which he does. Yeah, I applaud that. All right. And there's the promo slide for that event coming up next week. All right. Guys, I want to talk for just a minute about the elephant in the room, and that is we have a market that is being impacted right now by elections. This happens every 2 years, every 4 years in particular with the presidential election, has a bigger impact than it does on the off cycle election, which has to do with House seats, Senate, and House of Representative seats. But the presidential election sometimes has bigger impact. It certainly gets a lot of attention. And I wanted to talk a little bit about just some of the obvious things that might come to mind. I've heard people speculate and talk about what happens to markets during presidential cycles. And so I did a little bit of research. I mean, I've heard a lot about this and I've studied it in the past. But I just read a few articles this morning in particular that tried to explain from a statistical standpoint how markets are impacted by presidential elections. And the fact is that they are influenced. I'll give you some stats a little bit later on. But the things that we wind up seeing that we experience, this is the season, and it's not Thanksgiving and Christmas. Those are coming up every year, and I look forward to those seasons. But the election season seems to be more and more associated with vitriol, with insults, with attack ads, opposition research. It tends to get nasty, and the gate swings both ways. But I guess I'm nostalgic, and I wonder what happened to agree to disagree. Yes, that's something I grew up with, guys. I mean, I got a few decades behind me now, and it's kind of interesting that I can look back as far as I can. Kind of scary sometimes, but I can look back quite a ways. And agree to disagree was always something that was just kind of an assumption. You know, there's this kind of a background of at least you be agreeable. Yeah, you know, at least you can this agree to disagree, right? Ronald Reagan, Tip O'Neill, that famous relationship, which almost sparks a recognition of the classic reference to, for example, trial attorneys, you know, prosecutors and defenders that will tear each other apart in court and then have lunch together and say, "Hey, how you doing?" You know, and then they go back into the battle. You know, Reagan, Tip O'Neill, they had a great relationship off camera, if you will. They had their jobs to do, and they did them. They represented their party's interests, but they didn't hate each other. It seems like it's different now. It seems like it's getting worse and nastier, and I don't like it. Polarity seems to have reached greater heights. I can't help but think back about 9/12. Everybody knows 9/11, although some of you may be, gosh, it's far enough down now to where there might be some folks that have trouble remembering even 9/11. But I do remember 9/12. I don't know. How about you guys? Anybody remember 9/12? The national unity was palpable. It was comforting. It lasted quite a while. We had a common enemy and a common cause, and people let go of a lot of the pettiness, and we were very united for a while. All good things come to an end, though, right? The heat gets turned up, especially in this election season, and it seems a little more ideological than I can remember. There seems to be a very exaggerated effort to Well, I mean, the idea of slaying sacred cows is kind of a progressive kind of thing where you want to move forward, you've got to get rid of certain things. Um, it seems justifiable to those who are pushing the progress, but it doesn't sit really well if it's your cow that's being slain. And I've lived just to see in the last 5, 6 years, it's astonishing to me that traditional norms have been under the assault that they have, the division. Um, it's like there's an urgent rush to remake what's and redefine what's normal, and it's heightened the this election season, the last two cycles, and it bothers me that it is getting so um, unfriendly. I mean, just it's violent. It's the vitriol is. I understand the pushback, and there's a lot of pushback coming, and it's creating a lot of polarization. And I truly hope that we can find common ground again. I hope it doesn't take a catastrophe, but I would really love to see some common ground, and I'm not sure where that's coming from. I have noticed something that's very interesting, and that we all need to be careful of, and that is the media, especially with the introduction of AI technologies and some of the things that are happening. But the hype and the hysteria can be difficult. Um, I, I find, however, and I hope you guys have this experience. And I'm almost done with this. This has to do with what we're talking about in the markets today. But I hope that you have the experience that I have, which means that I don't see in my community the people that I associate with, which are all colors and all shapes and sizes. But I don't see the hatred and the some of the vitriol and the level of discord that I see in the media. I talk to people, and people are people. Yeah, we have differences of opinion, but don't have to be nasty about it. And yet that's all I see in the media. And I wonder who benefits from this. There seems to be a different world out there. If I believe what I'm seeing and hearing, I wonder who benefits from the dissent and the division. Um, it seems like the flames are being fanned, and I saw something. I've seen this several times, but I've seen people interviewing different just individuals that are out there protesting and whatnot. And I saw this exchange last night. I've seen it before, and somebody said to somebody who was out there chanting and say, "Do you believe that this person, they were talking about a political opponent, they're a fascist?" "Oh yeah, absolutely, they're a fascist." And they said, "Okay, what's a fascist?" Um, well, it's well, um, um, they didn't have a clue, and they asked several people. They were at some rally, and they asked that repeatedly. The names that they were calling their opponents. They said, "Well, what does that mean?" And it was really disturbing. Okay, it was really disturbing. Anyway, this is something that this is the last point I want to make here, and I think that it's powerful. This is the point that I'm making. Okay. He who takes offense when offense was not intended is a fool, but he who takes offense when it is offended is a greater fool, because they succumb to the will of the adversary. This is not easy, guys, because all of this controversy tends to bring up kind of the worst in feelings, and gets people opposed to each other. Um, this is impacting the politics, which impacts the markets because it impacts policy decisions. It's not easy, but it's worth considering. And I leave you with this thought from Rudyard Kipling. If you can keep your head when all others are losing theirs and blaming it on you, if you can trust yourself when all men doubt you, but make allowance for their doubting, if you can wait without being tired of waiting, or being lied about and not dealing in lies, or being hated without giving way to hating, and then the poem goes on for a lot more stanzas. But it's a great principle to consider in this environment that we're in right now. Um, Try not to let yourself get sucked into it. I don't see the vitriol and the hatred in the people that I associate with. I just see it being driven tremendously by the media. Okay. I do. Now, correlate this to the markets. When we look at market influence. We're also seeing it through the eyes of media. And I've pointed out many times that there are traditional media discussions that happen around events, whether it's the seasons, the end of the year, or whether it's an election season. To fill time, talking heads bring out all kinds of colloquialisms. And I want you to know that for the most part, when you dig into it, most of the colloquialisms that you will hear in the media don't have any bearing. Okay. In other words, for example, sell in May and go away. The Santa Claus rally, which has at least 3 different definitions now, at least 3 different contexts for the Santa Claus rally, all quite different. And yet it's talked about as if it means something. We get into election cycles and you'll have people looking up data, trying to come up with something to say, well, you know, this is what happens when this party gets elected or this party gets elected, or when interest rates are this rate. I did more research this morning just to verify what I already knew, just so I can tell you that most of these things are anecdotal. And in the long run, they don't have anything more than short-term impact. Is that important to us? Yes, it's very important, because as traders, you are not, at least everything that I see in Rob's classes and all of the things that are taught in everybody's class that's associated with Rob is about trading. And trading and investing are 2 different things. They're not the same things, guys. Investing is long-term, longer term. Trading is cyclical, it's shorter term. And so we hear about a large majority of the things you hear on news, whether it's Bloomberg or any other market-related news channel or source or internet-related, it doesn't matter where it comes from. The majority of it is defined or in the definition of long-term. It's investment advice. And investment advice and trading advice are 2 different animals, completely. Completely. When you look at this chart that I've got in front of you, you're looking back from 1970 until 2024, 23, the beginning of 24 here. And what you're seeing is interest rates. Okay. So you're seeing some incredibly volatile, wild swings in interest rates. Back in the 70s and 80s, we had incredible swings in interest rates. And then we had things settle down. And they settled down for quite a while. We had a powerful impact of interest rates dropping. You can see from the 2008, 2007, where we went negative. And then now we see since 2020, since the last election cycle, we've seen another huge swing in interest rates. Okay. Now, there's a lot of news that goes in and out through the seasonal cycles, as well as geopolitical events that happen. But interest rates are a huge component of how markets are able to function. They don't have a direct correlation in terms of day by day, but they have a swing, an influential swing. When you overlay interest rates on markets, the correlations is it's kind of a delayed reaction. Okay, it's a delayed reaction. Markets adjust to interest rates, but they don't adjust to the consequence of interest rates until they happen. And those consequences are delayed. So we see something now that in the last 4 years, we have seen an incredible increase in inflation. Now, it's interesting from a political standpoint. Some will point this out and talk about it in terms of what it's done. Others will say, who don't want it to look this way, which is actually what it looks like, will say, no, just look at it incrementally. Look at it, the change between last month and this month. See, it's getting better. Well, okay, you could do that, as long as you change your perspective. And so it's the same thing with investing and trading. You could look at this from an investment standpoint and make some long-term impacts or projections of what my investments are going to do over the next several years. But trading is often minutes or days, hours, maybe a month or two. But trading, active trading, is rarely more than a couple of months, isn't it? Right? So you have to try to filter what we're hearing and filter what you're taking out of news coming from the internet or cable, rarely newspapers anymore, right? We just don't do that. But news drives trading. It drives short-term impact. Bigger picture like this impacts investments, longer-term investments. And the point here is that it just depends on your perspective. If you look at this last 4 years of this interest rate growth spike, which has contributed to, or not interest rate, but inflation, the growth of inflation, and you can see that it's there and the pricing, everybody feels it. If you look at it on a tiny micro level at 2 months or 3 months, you might say, oh, it's getting better. Well, no, it's not. You can see here it's not. It just depends on the perspective, what you're looking at it from. And so when you look at news, when you take things into consideration on your trading decisions, make sure that you're keeping it in the context of the term that you're trading. And if you're trading actively, it's going to be short term. And here's the truth. Markets favor split houses. They favor elections where neither party has the trifecta. They don't have the presidency, the House, and the Senate. Markets historically favor split houses. Why? Because split houses don't allow for massive changes, massive fast changes. When there is a strong coalition, then you can get strong and fast changes that might have economic impacts that the market is going to have a hard time adjusting to. And markets hate indecision more than anything else. So a split house, a Congress that can't function very, very effectively is actually preferred by the markets because they tend to be a little more stable. Long term, whether the Republicans or the Democrats get into power, long term, it has minimal impact. I looked at a lot of studies that go back to 1947, and there's very little impact on the long term. On the short term trading, oh, absolutely. Absolutely. The swing cycles will have characteristics. You know, Republicans tend to favor business. Democrats tend to favor policy changes. And the markets will respond to those, and that's trading opportunity. But overall, you know, it doesn't make a big difference in the markets. It just doesn't. So as we go into this cycle, the market has been nervous. There's some volatility. That's normal. As soon as the election is determined, which may not be next Tuesday, we'll have to see. They're predicting, some people are predicting that it may take a while to sort things out. But once that's settled, the market will make its adjustment. It's already factored in what it kind of thinks might be going on. Once that's determined, then things will set a new course. And so from a trading standpoint, just allow for that. Don't get wigged out about it. From a trading standpoint, you can be very political or neutral politically. You can be very neutral. From a market standpoint, you just sit back and you be neutral. I would give you this last thought, and that is, I think this is the last one. Where is it? Did I not put that in? Oh, yeah. The last thought, the very bottom of this. Trade what the market is doing, not what you think it's going to do. That's Orionism. And ultimately, that's the best trading advice I can give you. Trade what the market is doing. Trade what the stock is doing right now, not what you think it's going to do. Not what the media says it's going to do. Not what your AI tool is projecting it's going to do. You use that to develop criteria. You use it to develop theories, or if this happens, I'll do that. You have your contingencies. If this happens, I'll do that. If that happens, I'll do this. Okay, great. Develop those. Now, what are you going to do? I don't know. It depends on what the market does. But whatever it does, if I have a plan, that'll determine my action. That's the way you make decisions, not based on anything that you think the market might be doing. All right. Now I'm going to change the screen sharing and I'm going to bring up the charts. And where did it go? Share screen right here. And I am going to go to an open forum now, and I'm going to invite you to bring up any stock, any issue that you want to bring up, and I will address, if I can get the text chat back up here again. There we go. I will address that and give you my feedback on any particular stocks that you want to take a look at. Jennifer or Brenda says, let's start with the S&P. Okay, so we got the SPY up here as representative of the S&P. And what we see is, let me get over here. I had this up here a little bit earlier. This is the last 4 election cycles. These are broken up in 4-year chunks, just to show you the response to market activity. I go to, that's a weekly chart so I can see a bigger picture. So if we look at this a little bit closer up, this is our daily chart, and we start getting into this a little bit tighter. Okay. Brenda, I do best if you can give me some sort of a question. I can analyze anything, and I will. I'll give you my opinion on it. But at the same time, Brenda says, let's do this one. My question turns around and says, okay, why? What would you like to talk about or determine when we look at the S&P? What I'm seeing right now while you're formulating your question is 2, 4, 6, 8, 10, 12, 14 days in a very tight trading pattern, right? Until yesterday. There we go. Brenda says, it seems to be in the middle of nowhere. Well, we were trading into a stall pattern. This is a wedge. I don't know if you can see the wedge clearly, but you've got a wedge pattern here. You got descending tops. Let me get that right there. There we go. Okay. So there's your compression into that wedge. And then yesterday we broke down. You can see very obviously where support is, and we headed down into that area. There's this support level from the previous month. And so we dropped down here, and that's likely going to be where it sits for a little bit. Okay. Brenda says, where's today's chart? This is yesterday. You're right. You're right. Because on this chart, I can't update that in real time. It doesn't update in real time. It updates later on. So that's just the way that chart is set up right there. Okay. But I'm just pulling it up right now. Sorry. Give me just a second. Right now, we're sitting at 7. So it's back up just a little bit, but we're still sitting right down here, right about where my cursor is right now. And so what is that, Brenda? That's support. So we dropped out of that wedge. We traded into it nice and tight. And when you drop out of a pattern, markets, traders, when I say markets, but individual traders will tend to go to some place that makes sense. In other words, if the price that we've been trading at is no longer something that's comfortable, we're going to go somewhere else where we can find a consensus. So Brenda, make sure that you understand this word and you put that in. Consensus. When a price action stabilizes, you have consensus. You have a balance between buying pressure and selling pressure. When markets move, when stocks move, when anything, a commodity changes price and starts to move in a direction, you have an imbalance, right? Buying pressure and selling pressure are no longer in balance, and one is overtaking and pushing and driving the other one. But consensus is where we have balance. Now you can see that there is a lot of consensus down in this area where it was. All right. Back in September and October, we spent how long? Count them up here real quick. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 days. Okay. That's 3 weeks of trading. So we spent almost 3 weeks stuck in a pretty tight trading range. The market was in a consensus, a price consensus. We were at equilibrium, buying pressure, selling pressure. Everybody was kind of pretty okay where things were. And then we had an imbalance. We had a breakout. And the buying pressure took off, pushed it up to another level. And we spent the next, 2.5 trading weeks trading into another tight compression of the trading range. And yesterday it broke out. Today we're still sitting down right at about the same level. Okay. So that's kind of where I put my mouse, 572, 573. That's where it's sitting right now. Right square in the middle of someplace safe. Now, guys, the reason we have patterns, the reason we have compression patterns, let me put it down right in the middle here of 559, 560. Can you see? Well, I mean, obviously, you should be able to see the consensus of trading. There was a full 2 weeks of trading. Previous month, there was a week of trading at that same point, a high that was established, and then it pulled back away, broke the pattern, came back down, found some strength, came flying back up, and got stuck in the same place around 560. Got stuck. Pulled back away from that, came back up, and right where the cursor is right here, we hesitated for 4 days and then broke through. Now, this is well established as a price consensus. Is it support or resistance? And the answer is yes. Right now, you can see it as resistance, but it represents consensus. That means that if the price were to drop back down to this 560 range, you would be in a position where you would have familiarity. Guys, when the stock stays here for 2 weeks, the buying pressure and the selling pressure are at an equilibrium. Everybody's kind of okay with that. Now, the active traders are frustrated because they want it to move, right? The longer term traders are happy because the volatility slowed down. There's traders in the market that don't really like the volatility. There's other traders in the market that love the volatility. So when it gets stable, you've got a bunch of people that are happy. They can move stocks around. They can make transactions. The market isn't moving fast one way or the other. They're able to trade. They're able to transact business without the markets, moving the price so fast that it makes it difficult. Those that want to see activity so that they can trade movement are frustrated. Eventually, one party gets the influence, gets the juice, and they take it away. And then you'll take off and run until you reach an equilibrium. Reaches an equilibrium, everything stops again. Okay? And that's normal market behavior, moving from support and resistance to another support and resistance. We trade those movements or we trade the static when it gets stuck. We just find a pattern. When you find a pattern, trade the pattern till it breaks. That's another Ryanism. Find the pattern, trade it till it breaks. Don't try to force things. Don't try to guess things. Trade what it's doing. When you find a pattern, trade it until it breaks. And then trade it differently or don't trade it. It's kind of that simple, guys. Right now, we're dropping into a support area. I would not be surprised at all if we kind of stay here. today's Friday. You'll have Monday and then Tuesday is the election. I would be a little surprised if it doesn't just stick around here. It's dropped down from where it was stuck to an area that has more support, perhaps. But I wouldn't be surprised if it drops back down into this area here, the 560, 561. Okay. Either way, this area right in here would be maybe a safe place to ride out the storm and then trade the reaction, trade the consequence, trade whatever comes out of next Tuesday. Okay. All right. Pick another one. What do you want to take a look at? Thanks, Brenda. I appreciate that. Cues. Okay. All right. We're looking at the cues here. Again, when you bring something up, give me a question, give me a comment, give me something to work off of. We got the cues up here. Why? Now the cues looks very different than the S&P, right? And if we take a little bigger snapshot of this, a little bigger picture, this one is begging to have some channeling work done to it. Come on up there, right there. There we go. Now let's pull this back in. All right, this is the trend that we're running in the cues right now. It's a long-term uptrend, but we are coming up against resistance. So let's pull in here a little tighter. Brenda says it looks like the S&P. It does not look like the S&P. Okay. Okay. So go back to the cues. This is a different pattern. Go back one more time. All right. This area, the last few months, is different. Now, what have we got? We are pushing up. We were pushing up to test the high from 3 months ago. This compression, the drop, of course, that's similar because this was a systemic or a whole market behavior yesterday. Okay. But with the cues, you've got a big pattern. And if this pattern, this compression, if it were to break down, this is where your most likely support is. Let me bring this in a little tighter. Okay. Your strongest support level is right here, about 480. Right. Then you've got another little hitch right here. And then bottom line is dropping down to this last major rally up, which is what we're coming off of. So we go back here in September. This was a nice rally up from there. But this would reflect your long-term, your support level is the long-term uptrend and this last rally. They correlate right here. They're around the 555 area. So let's push out. That 555 would represent support in the long term. That long term goes back quite a ways. Okay, getting close to 2 years. But that's what's in play right now. And I was a little quick on that. I didn't get this that quick as I was accurate. But if we pull this in, you're going to see the correlation. There we go. Now we'll zoom in a little bit on that. And that is a pretty nice baseline over 22 months. Okay. And now if we look at this, you'll see support down here. If there was, in other words, if there's a pullback in the market, you can see the Qs drop back down to the long-term support area. More likely, we hang around in this area till the election. Okay, you got major resistance, you got support, you got a lot of traffic, it dropped back into a safe area, a place where there was some consensus, price consensus. Okay, so what else? You have resistance up here that we just struggled with at 499, basically 500. And then you've got the all-time high popping up here at 504. So those are your upside targets. Very clear, very obvious, very good, solid, long-term 22-month support level in this pattern. Short-term, there's your consensus right in here in the short term, right around 483, 484, something like that. Okay. All right, let's take a look at Apple. First of all, we go to a big picture. Not quite that big. This is big enough. All right, so what do we see with Apple? Well, I'm seeing major there we go. Major resistance here around 236, and this has been going on for 1, 2, 3, 4 months. That's kind of a long time. What I'm seeing on the underside of this is this. So what we are witnessing at Apple, its hesitation here is getting into a trading range that is bound by, you've got an upper limit and you've got a rising bottom. Overall, if you looked at Apple and said, what is the long-term behavior of this? Long-term behavior of this is up. Okay, it's growing. It tends to continue to grow, but it is not uncommon for it to get stuck. If we take an example, a macro, you can see that here, and this goes for, boy, quite an extended period of time. You look how many months, 1, 2, 3, 4, 5, 6, 7, 8 months, 9, 10, 11 before it broke out of this. So technically we really should run this right to here. So you got a whole year that Apple was stuck in the trading range. 160 to 200, a 40-point trading range for Apple. Now, previous to that, you'd had a 7-month run up, a very strong bullish run up, and then you've got 11 months stuck in a trading range. Now it breaks out, it comes up, and what's it doing? It has a breakout, and now it's trading into another range. This one is a compression range, an uprising wedge, and that rising wedge is going to have an inclination historically for it to break to the upside. That's just kind of what it would be likely to do if it follows pattern. So compression, 1, 2, 3, 4, 5 months. We've had 6 or 7 months uptrend, and then we had 11-month compression. We got 5 months in a wedge. If this breaks to the downside, guys, watch the cursor. You've got support right in here. It goes back. You can see we had a resistance level. We have a support level. We have another support level. If it breaks down, this area here around 217, 216 is likely the support level. There's pretty good reason for it to find consensus there. If it doesn't find consensus there, it will look for the next one. The traders will look down here around 199. However, the significant thing about where it's at right now is if it were to go any farther, we are going to break an uptrend that goes back 1, 2, 3, 4, 5, 6 months. So we've got a 6-month uptrend, this ascending wedge. If it breaks that, I don't know what I know it's significant. I don't know how far it goes. Okay. I don't know how far it goes, but it is significant because it'll be breaking a pattern. Brenda says, and a gap fill too. I did not catch where you were referencing the gap on this. So let me zoom in a little bit closer. Which gap fill are you talking about, Brenda? Give me a time reference. At 216. Okay, well, there's 216. If you're talking about this little gap right in here at 216, there's no gap here. That's been filled. This is a little abandoned baby type pattern from a candlestick standpoint. But this is not a unfilled gap, because you go back to the left. A gap, when you trade through a gap and you can't go to the left or the right, obviously you can't go to the right, but if you can't go to the left for a long time, it's significant. If you go to the left and a few days ago you traded at that point, that gap loses credibility. It loses significance, Brenda. In other words, this little hole right here, if this is what you're referring to, is insignificant because that was traded just 5 days earlier. Okay. So I don't see any gaps on here that are going to impact, that I would expect to impact for Apple. But I know that's in a support area right here. So if it follows the market and the market just hunkers down for a couple of days to see what happens in the election, well, then so be it. That's what it'll probably do. But the significant thing for Apple is to come back up and test the 236 area. That'll be very significant because a breakout above that continues the uptrend. That would be the inclination. However, breaking down below this line, which goes back 6-7 months, that would be significant. And you would look for these little drops along the way. And if they don't work, if that doesn't hold, you got a real nice one down here at 215. Now, if you're trading bullish on Apple, you wouldn't be real excited about that. But from a trading standpoint, it'd make a lot of sense. Now, don't get me wrong. You got a lot of reason for this to be a real strong support, this 216, 217, 218 area, real good support. But if that doesn't work, there'd be the next one and be a lot of reason for it to go there, because that's where you could find a price concession, or not concession, a price consensus. Thank you. All right, one more. And there we go. All right, question on NVIDIA. Who had that? Let me scroll back up. Oh, I saw that. Thought I saw. Could have swore I saw somebody put up NVIDIA. Anybody want to look at that? Yes, no? Maybe I misread. All right, give me another one then. Brenda says, why not? Okay. Okay, I need to rectify that on the split, but let's just take a look at this. What are we seeing? Okay, big drop yesterday, proportionately, following the market. But is that red candle necessarily a big drop with NVIDIA? And the answer is no, it's not. The candles we saw were significant on Apple and on the SP. They were large drops. On NVIDIA, this is not a large drop. This is just a red day. We have a lot of red days. We have a lot of them bigger than this. Did it follow the direction of the market? Yes, it did. It did. But was it a big deal? Yeah, I don't think so. It just, kind of followed the market direction. What have we got going on with NVIDIA? We just took out on a adjusted level. We just took out a high and then slipped and followed the market back. I would see this as indicating NVIDIA is strength. I would see this as strong for NVIDIA. Now, is this line mean anything right now? I don't know. I only have 2 points. 2 points makes a line. It doesn't make a trend. So I'd lay this up here and say, is that line, you go up to the first rotation here, and what do we got? Well, is there anything in here? I don't have an answer for that. I don't know. This is how you do it. And if there's something there, there's something there. If there isn't, there isn't. Um, NVIDIA is definitely in an uptrend right now. Is it something that we can identify very well? I'm not sure. Not sure. I'd like to see one more rotation on it to believe it. We're coming out of this downtrend for sure. And so now the question is, what's driving this on the upside? If I take out some of these lines, I'm going to try one more. And I'll show you another way to take a look at this. But my philosophy on this is that you use the pattern kind of rules for drawing trend lines. And if there's something there, there's something there. If there isn't, there isn't. Don't try to force it. If we take a starting point here of breaking out of that pattern, we can look at this and say, okay, now there's 3 points that are lining up. If it were to bounce off of that, let's just see if we can correlate that any better. And we go up here and we go, oh, interesting. Is there one more? Pull this up to the support level. Zip over to a line chart. I would leave these lines on the chart for a while and see if it doesn't continue to follow this. This looks more believable. It takes 3 points to establish a trend, not 2. Do we have 3 points? No. With yesterday, we don't, as far as where it stopped. Now, that doesn't mean that we don't have it happening today. Right now, we're sitting at 136 even, which means that we're trading up at, let me get this at 136. Okay. So if NVIDIA stays in this area, if it trades at or higher than, let's say, 133, 133 and a half, 134, if it trades up here in the, above 133, then you could call out a third point and you could say, okay, let's see. Because we do seem to have a correlation between top and bottom, resistance and support. There's an intermediate line that seems to have validity. And so this would be a pattern that I would be willing to start trading NVIDIA off of if I wasn't already in it. I mean, you could have been trading on this when it broke the uptrend or the downtrend, when it broke this line right here, which is your resistance line on the way down. So once that broke in this breakout here, that's a trading point for sure. But now in this pattern, I can start to find support and resistance line for entering and exit different trades that make sense to me. Okay. But it takes 3 points to create or establish a trend. And it looks like it's forming that. It depends on where it closes today. If it were to turn around and close today below yesterday's close, then I would say, no, this was preliminary, promising, but it's not there. If it establishes a closing price today above 133, 34, 35, 36, anything in that range, I would establish that as the third point, and that becomes a significant trading point, a pivot point. And from that, I can trade either up or down. If it breaks that, if it were to trade it, let's say it closed at 135 today and then turns around and on Monday takes out 133 and heads down, that would be a bearish entry point for me. Okay. Any movement forward off of this point after it closes here, if it breaks to the upside, that's a potential entry point to the upside. And from a target standpoint, you have 2 targets, right? You have 2 targets. If you start to the upside, the first one would be where we just banged our head and ran out of gas right here at 144. And then the next one would be up to the top of the trading range, which would be up at around 448. Sure. So those would be your 2 upside targets. On the downside, if you took out that 133-ish area right there, your downside support starts to come into here. There's a real good level down there at 116. Will it go that far? It could. Can it drop that far? Absolutely. Do it very easily and still be bullish. Okay. It's an incredible company, guys. Just an absolutely incredible company. Their product line is so deep, so strong. They've got an established position that muscles out competition and stays ahead of competition. They are one of the drivers and the forefront drivers of AI, as far as programming and into their chips. I mean, they're strong, but that's what I would look at. All right. All right, guys. Well, there you go. Be careful, be safe, have a good weekend. Please vote. Please do not be discouraged if you are. Your vote counts. Do it. Whatever that vote is, it's sacred, and take advantage of that. As far as market volatility, we're likely to see some major change in market directions. Probably not from an investment standpoint. Hold the line from an investment standpoint would be the advice that comes from all the research that I looked at. But if you get volatility, trade it. Which way? Whichever way it goes. Find the pattern, play it till it breaks. Trade what it's doing, not what you think it's going to do. Best advice I can give you. All right. Take care, guys. God bless. A lot of you are saying you already voted. Good for you. Good for you. God bless, guys. Have a great weekend. Bye-bye.